In the last week or so, $10 trillion in the stock market has vanished. And naturally, investors are nervous. Tariffs are at the top of the headlines, as pretty much everything is about to cost more. And interest rates are still putting pressure on borrowing costs. So you might be wondering, where can you put your money right now while still earning something and without taking on a big risk? And I think that's where dividend stocks come in. Dividend stocks pay out cash to investors on a regular basis. But can they hold up when the market's falling and companies start making less money? Hi, my name is Rick Orford, and I help investors like you make more informed decisions about their investment dollars. And today, to break it all down, I'm talking with Steve Sosnick. He's the chief strategist at Interactive Brokers. We're going to be looking at how dividend stocks usually do during market drops, how to tell if a company's dividend is safe, and the red flags to avoid when chasing high yields. Steve will also share which sectors and regions look solid and how he'd build a dividend portfolio from scratch today. But before we begin, I wanted to give a shout out to The Motley Fool for sponsoring this video. The Motley Fool provides investing insight and stock recommendations for investors of all types. So I'm thrilled to partner with them to bring you 10 stock picks from Stock Advisor. Stock Advisor returns are up 730% versus 147% for the S&P 500. You can go ahead and scan this QR code or check the link in the description to get your 10 stock picks right now. Okay, let's get started. Steve, thank you so much for joining us.
My pleasure to be here, Rick. Great to have this conversation.
Excellent. So, Steve, let's just start right out of the gate. How do dividend stocks perform in bear markets versus those that are, what we call growth stocks?
You know, dividends provide a bit of ballast to a stock. So, for example, one of the things when you're looking at growth stocks, for the most part, is they don't pay a ton of dividends. There's a logic to it. The logic is that they're growing so quickly that whatever cash they generate is better spent being reinvested in the business. That's changed a little bit because so many stock companies do stock-based compensation. They spend a lot of money on buybacks too, which indirectly are returning money to shareholders. But in many cases, they're issuing stock as part of compensation plans, and they sort of buy the stock back to keep the float roughly unchanged. But in general, that thought process holds that the growth stocks are using the money in a fast-growing business, reinvesting it. The dividend paying stocks say, you know what? We don't have as much necessarily in terms of cash needs right now. We're able to return actual cash to investors, not just through buybacks, which, basically effectively benefit those who are selling into the buyback. And so they may not necessarily run as far and fast in a bull market, but what they do is they tend to outperform in rocky markets because there's something to be said about getting a check every quarter, or having that money hit
Sure.
your account or reinvested, however you want to look at it. That is a big help.
Sure. So the stock price itself becomes almost secondary to the actual income that we're receiving.
Well, think about it this way. If you think about sort of classic, investment analysis of how you would value a company, it's really the present value of the future cash flows. Whether that's, you could express it in earnings or whatever. But one of the things that's very interesting to me is one of the lessons I was taught very early on is companies can manage their earnings. The whole aspect of pro forma in some ways I like to joke that it's Latin for ignoring whatever inconvenient expenses I choose to ask you to ignore. You could time you could time receivables, things of that nature. It's almost impossible to fake cash flow. Cash flow, cash flow occurs no matter what. And so companies that pay dividends in general have solid cash flow. And so in general, the perceptions, let's say the multiple that the market puts on their future revenue streams, their future earning streams, their future cash flow streams, tends to be less variable because you have this steady receipt of money. Every typically they pay quarterly, sometimes annually, but you have this steady receipt of money, and so you may be sacrificing a little bit in terms of growth, which is why value stocks tend to underperform in very robust markets, and we saw this for the better part of 5, better part of 5 years, certainly most of the last 2 years. But this is when value stocks shine. I'm fairly proud of the fact that, in almost every interview I've done when over the past few months, when people have said, "What would you be focusing on?" And it was low beta, high dividend paying stocks. The reason for that being that, um, for the most part, assuming these companies have solid businesses, and we'll get to the risks, and we'll get to some of the risks to dividends later. Not every company can and that does pay a dividend maybe should be paying a dividend, but for the ones who can easily afford to do so, they have the sort of stable businesses that tend to do well when the environment gets a little rocky.
That makes a lot of sense. So we were just talking about the risks. If one buys a dividend stock, how can one tell if the dividend is safe? Especially in this environment where we have tariffs and earnings, which will likely take a hit. How do we know?
Well, there's no way to know with perfect certainty, but the best indicator is the free cash flow being generated by the company greater than the dividend they're paying. That's essentially telling that to me is the simplest way of saying they can afford to return this cash to you every few months. It gets a bit riskier when companies borrow to pay dividends. This happens particularly with companies where private equity still owns a big chunk of it, or where they just recently a lot of times, a lot of these companies will IPO. Of course, nobody's really IPOing right now, but in a more normal environment, they'll go public, and then they'll recapitalize by borrowing money to pay a dividend to the shareholders. That can be a bit more of a red flag because you can't do that endlessly. You can, but if company XYZ, and I tend to talk in terms of sectors and generalities because I'm not a individual stock analyst, so I'm going to keep it sort of more broad. But if company X earns 50 cents, basically has a very steady cash flow of 50 cents a share, and they pay a dividend of, let's say, 30 cents a share, you could be pretty sure that that dividend is well supported. Actually, might have room to go up. What you don't want to see is the company tends to have free cash flow of 15-20 cents a share, and they're paying 25 or 30. That seems a little unsustainable. That requires something to change for them to be able to maintain that dividend. Or again, or if they start to borrow heavily to pay the dividend, those those can be a bit more risky. And so I would tend to focus as I said, cash flow is incredibly hard for companies to manage. Outside of, to manage other than managing their business. That's really the only way you can manage cash flow, on a balance sheet or an income statement. So, that to me is really the thing you have to be looking at.
Excellent. Now, you mentioned looking at free cash flow and ensuring that that covers the dividend. On many platforms, it's called the dividend payout ratio. Would that be something that you would look at?
Yeah, that's
Oh,
that's
great.
a neater way
And
of putting it. But yeah, you want that number to be positive. You want the coverage. You want some safety in that. One another good thing about dividend payers is it's usually the last thing that companies cut. They're very loath to cut dividend payouts because it sends a very negative signal. I'm thinking about Walgreens recently, which cut its dividend, and that was a sign that, oh my, uh-oh, they're in some real trouble. But again, they were not generating sufficient cash to pay their dividends, so it became inevitable. But the signal that cutting a dividend sends is usually perceived as quite dire by markets. So that's why, you can't just say any company that pays a dividend, um, is a good one. But what it does mean is if companies can pay, and it gets a little rocky, and let's say you have a bad quarter or two, they will try to maintain that dividend as much as they really can. I guess the other pitfall, by the way, which I should have mentioned, is don't be seduced sometimes by high yields. If the if the yield if the yield is too high, a lot of times that's a sign of trouble. That means that that can often mean that the stock price is eroded underneath, because remember, the dividend yield is the amount that you receive in dividends divided by the stock price. That a lot of times means that the stock price is eroded to such a point where the market is telling you that maybe not this quarter, maybe not next quarter, but at some point this company is going to have to cut its dividend because it's perceiving it as unsustainable. That can be a trap sometimes.
Mhm, mhm. And, earlier you were touching on sectors, as a sector analyst. What sectors do you think, would be likely or to grow dividends during a market downturn?
Well, right now this is a tough one because we're dealing with truly uncharted waters here. In general, consumer staples tend to be solid, right? I mean, you're still gonna brush your teeth. You're still gonna use you're still gonna use all these various household products and food items that you got to eat. And so those tend to have stable dividends. Again, growth, if you know, right now, it's like, depending on who you ask, the recessionary environment there's a potential for a recessionary environment. Let me not be dire, but if you get into a real pullback in the economy, it's very hard for most companies to raise dividends. Utilities, utilities are very predictable dividend payers. It's pretty much in the way they're structured. The demand tends to be pretty inelastic, tends to be stable. Yes, it does tend to go down a little bit if economic activity goes down, there's a little less energy generation, a little less electricity need. But for the most part, these are state regulated entities, so they pretty much know how much they can charge. They pretty much know how much they're likely to receive. And then they tend to pass it along pretty predictably. So, dividends are pretty much the ultimate stock. But again, then you are really, in most cases, sacrificing, except for a brief period there when the AI wave was cresting and people were using utilities for speculative purposes. For the most part, your average utility is quite boring. You don't get a lot of growth, but you get a nice steady paycheck. So that's one end of the spectrum. But again, I think, you could start to think that, if as the tariff situation plays out, and you have winners and losers, perhaps some very, sort of plain vanilla, sort of semi-boring manufacturing type of companies can maintain or potentially increase their dividend depending on the flows of business, whether they can repatriate business quickly and efficiently. Some of them might be able to pass along higher dividends as well.
Makes a lot of sense, actually. Sometimes you just got to go with those boring stocks to get through these sort of situations. Actually, a lot of this I heard the last time I heard it was 2008, 2009. It's interesting that we're talking about it again today. Uh, Steve, if you were building a portfolio today, how would you spread the risk across? We were talking. You're a sector expert. How would you spread the risk across multiple sectors?
This is when diversification is better. Now, if there's a real tidal wave in markets, it's going to be tough, regardless of what you do. So certainly, I think first and foremost, um, make sure you have enough cash on hand, and especially right now, people were scoffing at it. Oh, 4%, is it barely making money on inflation? You know what? The people who, the portion of people's portfolio that was earning 4% in boring cash or cash equivalents looks pretty good right now considering the alternative. So make sure you have enough. There are risks and rewards to speculation. Right now, you could see it. The markets are very volatile. If you can if you can surf those waves, great, but it's very difficult to do, which that volatility is telling you. So first and foremost, figure out what your near and long-term needs are. A few months of liquidity. If you have any major life events planned, buying a home, getting married, kid going to college, impending retirement, you do want to make sure that you have a lot of, money, let's say. And when I say cash, I'm saying, let's say, 2-year notes or less. Saying to raise cash now is sort of like shutting the barn door after the horses left. But but it is this ought to be a reminder that the things that there's always times where you want to make sure to not have stuff too much stuff at risk. So hopefully people had been doing that before, but um, definitely do that now. Doesn't mean panic sell everything. I also think that this is where diversification tends to work because it's very tricky right now to pick winners and losers. So whereas it was fairly eh, it was fairly obvious in the last 2 years, close your eyes, buy tech stocks and, check your portfolio periodically and see how much money you made. That's not necessarily going to work now. Also, we've seen the US underperform relative to foreign markets. I was on a panel with a friend of mine who's a financial advisor couple of weeks ago, probably couple months ago at this point. And he was sort of touting the American exceptionalism, which was true at the time. And I'm like, you don't ever sleep on foreign markets. Again, 2020 hindsight, most foreign markets have outperformed the US recently. But that again is, I think, the flow of the money tide receding. So don't be afraid to diversify internationally as well. Right now, with this kind of uncertainty, I'm not saying, go go crawl into a fetal position and hide somewhere. That's the wrong strategy. We're gonna look back at this and say there were some great buying opportunities, not necessarily for everything all the time, but these things create winners and losers. And there's a lot of stuff that's on sale. But I think don't be afraid to diversify. Let's say, as we're at topic of the conversation, growth. Make sure you have growth and value. Make sure you have some international exposure. First and foremost, though, make sure you're not investing what you can't afford to lose money on. And that's really, I think, the key, that last piece of advice. I think these are all decent pieces of advice. I think we tend to lose sight of it when we see markets perform one way or the other and say, wait, why am I wasting money by having a European, by having like 5% of my portfolio in European stock fund, when the US is just cruising ahead? Well, markets tend to surprise people at the worst times. And so that's, I think, just general advice. And I think, right now, be judicious. Understand that markets are going to gyrate, and understand that accordingly until we sort out how this tariff situation is going to play out in the medium to long term.
Thanks, Steve. I just keep nodding because I agree with everything that you've said.
Well, thanks, Rick.
Steve, I have one last question for you. Is this time different?
Ooh, the most dangerous phrase in investing. Um, yes, because I don't ever recall something like this being not. There's always an exogenous component to it, or there's always a component of excess when you see markets sell off like this. But this one, basically there's a simple way to assuage the markets, and that is, reverse some of the tariff policies, but we're not gonna see that. In many ways, the market reaction is similar to the COVID crisis, where again, we came in with relatively frothy markets. They got upended, but that was purely that was exogenous. The global financial crisis came at the end of a huge period of financial excess, but that unraveled over time. People kind of forget that the first leg was really March of, actually transpired sort of over the same time period, beginning of 2000, late 2007, early 2008. The first wave was March 2008 when Bear Stearns went under, but then it kept going. 9/11, that was exogenous. Bursting of the internet bubble, again, period of excess. The Federal Reserve pumped in money, which was exacerbated by the Fed pumping in money ahead of the perceived Y2K crisis, then withdrawing that liquidity after the crisis never, I was going to say abated, but never really occurred. And that was sort of the push over the edge. So there's all these different things, but in this case here, the difference between, let's say, the COVID crisis and now, which transpired at similar rates, the Fed was in a much different position to act. Inflation was very low, and demand had fallen off a cliff, but it was fairly obvious why. And so they were able to come in, massively intervene. I don't see them being able to do that right now. Chairman Powell has basically said, what we got to see what this effect is, because because there is a very real risk that they could reignite inflation. And in doing so, before it's obvious that the economy is in real trouble, they're not going to react. And, it's sort of like don't fire until you see the whites of their eyes kind of thing. They're not going to do that. And in terms of the fiscal response, because remember, there was a massive fiscal response by the U.S. and other governments, as well as it was also with massive intervention by other central banks. The government is moving. The government is moving the opposite direction. We're literally shrinking the size of government. I'm not saying this in a political manner. It's just you're not going to get you're not going to get a $1,500 check as a result of this. It's just not going to happen. And so the way the markets are responding tend to be fairly similar. So that's why I'm not going to go full this time. It's different, but I think that the expectations for that sort of shock and awe response, you can't have them right now. And I think that's kind of what the market is wrestling with, is that, it's much harder to expect the cavalry riding into the rescue right now.
It's very good insight. Steve, have I forgot to mention anything or ask you any questions, or do you have anything further that you wanted to bring to us today?
I think we've covered a lot. How about we save whatever we might have forgotten for the next visit? How's that?
The next time.
Okay.
That's great. Thanks so much, Steve. We'll see you
Thanks for
next time.
take care. See ya.
Bye now.
Bye-bye.